So we'll continue talking about all of these things. We have our panel with us. Peter Barisi is joining in on the panel as well, University of Maryland. Jim Moran at Northbridge. Eric Schiffer with Patriarch Equity joining in along with Chad and Lindsay have already been with us. You know, we could talk about the Freeport-McMoRan thing, certainly, and we will throughout the hour. I think, Peter Barisi, to go to you, though, I'm sure you'd want to jump in on some of the things that Chad and Lindsay have been talking about in terms of economic growth, what we've seen in the market, and both of them saying that the problems, such as they are that we're having economically, are not U.S.-centric, they're global growth problems. Your view on that after the GDP figure and where we are here in the United States in terms of the economy?
Well, what we're going through is an adjustment in the global economy. China is not going to grow as fast, but the United States is going to grow more rapidly. That means a change in the structure of valuations, away from resources and more towards technology and the like. That creates a lot of uncertainty for the market. It knows the economy is solid, but it doesn't know where the opportunities are. So you're going to see a lot of ups and downs. But fundamentally, the economy is much stronger today than it was 2 or 3 years ago. And the part of the global economy that people can read, that is transparent, that has reliable information and data, the United States is where the strength is. That has to bode well for stocks globally over the next 18 months. Okay,
so that's 3 for 3 there in an agreement in terms of where we are in the U.S. economy. Jim Moran, your take then on what it means for our markets. There have been, and even this intraday chart that we're showing now in the NASDAQ, and they all kind of look the same with the wild rally into the close, and on another day it might look the opposite. There have been very, very big intraday swings lately. The message in that to you is what?
Well, first of all, it's nice to see green today.
Yes.
And I think, you know, technology has certainly been a safe haven here. And, you know, the innovation side of the economy is certainly holding up. And that's really where we're focused. And so you look at the market volatility has clearly been, you know, crazy. But when you look at technology companies, the companies sort of leading the economy, they've been holding up, I think, quite well. And that's really where we're focused.
Eric Schiffer with us as well. What about the valuation of some of these companies? Because there's been an argument now this week in terms of, is the market, generally speaking again, is it at an expensive level? Is it a point now as we see the shoot up where we really should start buying and it's going to be long term? What's your take on valuation?
I think they're ridiculously high. I think they've been high because of the Fed. I think we've got the Fed now that can't save the market. They're not going to. They're no longer going to prop things up, and so I think you're going to see a big repricing. I think that's what we saw the other day. I do think this is a blip. I think we're headed down. I do think that there will be a further repricing, and it will get. It's going to get painful.
Right. So that's the argument, right? And we can go back to Chad and Lindsay, who are here with us in the studio. Chad, that's the argument: is it a blip? Or we're kind of stabilizing here for another move up. There are, you know, optimists out there. Brian Westbury in the network earlier today, for example, saying, boy, we could gain 15–20% by the end of the year. So there are definitely two sides to this. Where do you stand?
Yeah, I wouldn't be that bullish about the overall market. Look, we're fairly valued at best at a forward-looking PE multiple of 15 times. Margins on the S&P 500 are elevated, and they are coming down. Earnings growth on the S&P 500 is somewhat muted as well. And future forecasted returns that we have is basically for 5% total return over the next 7 years on an annual basis. So we're advising investors to just move up the quality spectrum, be pragmatic about your asset allocation that you have, and to basically watch out, because there's going to be a tremendous amount of volatility over the next several months.
Well, fairly valued at best, though, is not as dramatic as what we heard a moment ago, which was, well, I forget the exact phrasing, Lindsay, but ridiculously overvalued. I mean, where do you sit on that expensive versus not expensive argument in the market?
Well, you know what? I think that the valuation has come back down. Like I said, it's at about 16 times on a forward basis, which is in line with the average. I think you're going to see a lot of volatility here, and I think that the market has really struggled when it's gotten over 17 times. So I think a fair value for the market is going to be anywhere between 15 to 17 times until we get more clarity on a lot of these issues, like what the Fed's going to do. We need to see corporate earnings growth above the 3% where we're at right now for the next 12 months. And so that puts you at between 1835 and 2075.
All right. But again, better, as we heard a moment ago, to see the green than the red with these wild swings we've seen the last few days. Thanks to everybody. We'll be back to you. Melissa, back to you.
Yeah, we want to go to some more.